Welcome to Sathish Speaks channel. 59,885. That is Sensex closure today, September 23rd, 2021. Market has a crazy level. It is euphoria. It is a festival time. I would have to say that when the market crossed to 50,000, we felt that okay, it's a all-time high, crazy level, and then it crossed to 55,000. We felt oh my God, it can't go beyond this. This is the crazy levels, and then every week it has scaled the new peak, and today we are almost at 60,000. So that is the level of market. My question at this point in time to all the investors is, if a Sensex goes down by 15%, there's a short fall in the Sensex and it goes down by 50%, how much your portfolio will go down? I have seen many investors' portfolio goes down by 40%, 50% if the market goes down by 15%. My question to you is, have you ring fenced your portfolio? Is your portfolio is having a shock absorbing system, or are you having a cautious approach when the market is at crazy levels? I'm Satish, financial consultant and author of this book called Untold Wealth Secrets. If you have any question or advisory recommendation in equity markets, a mutual fund or portfolio management for equity market, you can connect with me. My WhatsApp number is there in the description. And please click the like button so that it will have a probability to reach out to many people. This information can reach out to good number of people. So my first information to you is that what actually triggers a rally in the market? What is exactly the bull run? So bull run can happen because of these three essentials. Number one essential is that the actual growth. When the company produces profit, when the company shows the earning, when the revenues are at good levels, the sales are at good level, the profit at peak, of course the company share price will go on, and then there is a growth in the stock market. That is an actual growth. The second growth the rally can trigger is that the liquidity. Today, what we are experiencing is the liquidity driven markets. Many economies, many countries are practicing their quantitative easing. They are printing more monies, and then the money is available, circulation is available in the market, and that comes to the stock market, and the prices are going up. It is a liquidity driven market. Number three, which is sentimental, and of course, the sentimentals are very, very high today. We are having a very, very positive forecast that Mr. Rakesh Jhunjhunwala's opinion that Nifty itself will cross 90,000 1 lakh, and Mr. Ramdev Agarwal, the co-founder of Motilal Oswal, he is having an opinion that Sensex will cross 2 lakhs. And of course, Indian GDP, Indian stock market is a very sweet spot, comfortable position, very good fundamentals. It will hit these levels. Even I have no doubts. But what if there is any fall in the short term? Is your portfolio is ring fenced? Now, if you follow these five criteria, I am sure that you can also reduce the fall or reduce the impact of the fall. So number one is that avoid large position at this point in time. Many retail investors, what they do is they will have complete greed when the market are at high. They will feel that they have already missed the bus, and they will take a large position at one go when the markets are at a very peak level. So never ever put all your money at lump sum at one point, one single point. Divide your investments into multiple regular levels and invest in multiple regular levels when the market are at high. So that is my first recommendation. Second is, there are three segments in the market. One is cash, another one is intraday. The third is that the derivatives. Strictly avoid leveraging. Never take large position in leveraging. Leveraging is that you put 10% of the money, and 90% with the help of funding, you are actually purchasing some positions. What if there is any fall in the market? So never ever take derivatives position at this point in time. That's number two. Number three, check whether your portfolio is a quality portfolio, because when the market comes down by 15%, your portfolio is a non-fundamental stock. It can go down by 40% or 50%. Markets are at peak. So if you are holding any stock which is fundamentally not a good stock, it is probably a good time to dispose them and change your portfolio to a quality portfolio. Analyze the quality of the company, financials of the company, the valuations of the company, and then construct a portfolio, take position. So number three is that the quality of the portfolio, please give adequate importance to that. Number four, practice asset allocation. I have seen that most of the investors put all their money into one industry or one particular category. All their money would be in large cap, all their money would be in the small cap. So that is not actually a good approach. First, devise what is your objective when it comes to return expectation. So how much percentage you want to present in large, mid, small, and probably if you are a very high risk aggressive customer, if you want to participate in micro cap, you wanted to pick up some kind of idea which is a multi-bagger idea, you can include that in your portfolio also, depends upon your research. So asset allocation is the foundation. If you practice it, you can always reduce the losses. And most importantly, the final piece of advice, which is you have seen a good profit appreciation in your portfolio, but that profit is a unrealized profits. If you wanted to book some profits, it is probably a good time to shave off only the profits in mid and small cap segments. If you want to book some profits, book it and put it back into a low risk scheme. So for example, you can choose mutual fund schemes like a balanced advantage fund where the equity participation is only 50%, or even schemes which has equity participation is 15%, or even choose schemes which is 100% debt fixed income schemes. So depends upon your idea, your wish, because when you are actually booking profit from a high aggressive mid and small caps, that is a high risk. And you are putting it back into 40%, 30% means that you are reducing the risk. You are participating in the market at the same time you are reducing the risk. So that is something kind of a balancing act. And most importantly, last but not the least, never exit the market with fear. Don't think that this is the end of the world. Market is touching 60,000 rupees. Okay, now I have to vacate this space. I have to convert all the money into gold, all the money into fixed income. Don't do that, because historically, last 1.5 year, 2 years, these fixed income, gold, not going to give you returns which is more than inflation. So don't vacate this space. This is very exciting space, and India is in a very sweet spot. But apply caution. That is what my message to you investors. So I am Satish, financial consultant and author. And if you have any recommendation, advisory, connect with me. My WhatsApp number is there. And if you want to join my WhatsApp group, and again, the link is there. If you want to open a DMAT account, the angel broking link is also there. I will help you in picking up good stocks, good portfolios to you. And if you like this content, click the like button, and if you are clicking the like button, there is a very good chances that it can reach to many more subscribers, many more people. So I'll meet you with another interesting video with another interesting information. I'm Satish. See you. Bye bye.